Okay, let's get started. So my team that is joining online, just confirm. Can you see my screen and can you hear me before we start? Those
Yes, sir.
joining online, okay, thank you for confirming that. Welcome to our first session, management accounting. So this is our final subject. So we did the revision session for business and technology. We did the revision session for financial accounting. So today we want to go through management accounting. That is F2. So regarding the structure of the exam, I'm sure by now you are well versed with how the questions are like, because the nature of MA is more similar to FA. However, there might be slight differences, such as for MA exams, you have your formulas with you in the exam. So you might need to refer back to the table of values, or you might need to refer back to the formulas in the exam. There are quite a lot of formulas for management accounting. Yes, we do need to highlight that. There are quite a lot of formulas, but it's not difficult. It just needs someone that practices a lot. Okay, so as you can see on the screen, the exam is 2 hours, and the pass mark is usual, it's 50%. Your exam is made up of two sections, that's section A and section B. And for this one and FA, time management is key. It's very important you manage your time. So section A is made up of, so we have section A with 70 marks, 35 questions, section B with just 3 questions, but carrying 30 marks. So it's very important that you do complete all the sections in time. So a lot of people fail to complete, not because they want, but because of failing to manage time. So it's very important that we manage our time. Okay, let's move on. So the instructions page, I think this one is the same for almost all the exams. You can go through this one at your own time. You can go through this on, so you can go through this at your own time. So let's get started without wasting much of the time. Let's get started. Okay, so just a moment, let me see, someone is trying to join. A manufacturing company benchmarks the performance of its accounts receivables department with that of a leading credit card company. Which type of benchmarking is the company using? Okay, so the first thing that you need to understand before we get to, for the theoretical questions, you do need to have a detailed understanding of the subject. Before we can just speak the correct answer, there is need to first of all understand what benchmarking in this particular instance is. So if we are talking about benchmarking, if you are talking about benchmarking, what does it cover? So benchmarking, who can help? What is benchmarking? Just a moment, I need to assist someone who is failing to join. Let's proceed. So which type of benchmarking is the company using? So let's start by understanding what is benchmarking. Let's start by understanding what is benchmarking. So let's start with understanding what is meant by benchmarking. So if we are looking at benchmarking, this involves comparing your performance with that of, it could be the best in the industry, or it could be comparing with another department with the objective of doing better. So if it's benchmarking, it means you are comparing. If it's benchmarking with a competitor, you find the best competitor in the market. Then you find out what is it that is making your competitor so successful. You copy the good traits from the competitor. Then you also identify where the competitor is doing it wrong. Then you work on improving the weaknesses that the competitor had. So you copy the good traits and also the weaknesses of the competitor. You find ways to outdo the competitor. So that is in benchmarking. So if it's competitive benchmarking, you are benchmarking against your competitor. You're comparing your operations with that of the competitor with the aim of improving the areas where you are not doing well. So you want to copy the good traits from the competitor, then for the weaknesses that the competitor is having, you outdo the competitor. So we can have competitive benchmarking. We can have competitive benchmark. We can also benchmark. So there are different types of benchmarks that we were given. So let's go to, so we were given internal benchmarking, strategic benchmarking, functional benchmarking, and competitive benchmarking. So we have looked at competitive benchmarking. This is where you're competing, you're benchmarking against the competitor in the industry. So let's go and look at the other forms of benchmarking that we are given. So besides the competitive benchmarking, we can have internal benchmarking. So if it's internal benchmarking, it means the benchmarking process, you're comparing different processes within different departments of the same organization. So internal benchmarking. This involves comparing the departments or processes of the same organization. So you're comparing how they are doing it in Department A. Why is Department A is able to meet their targets? So this involves comparing the different departments, understanding why this one is doing it better. Then you copy the areas that they're excelling in. Then for the areas that they are lacking in, you also find ways to outdo them. Then we have functional benchmarking. Functional benchmarking, it is an element of competitive benchmarking. So you're comparing with a different organization, the different departments, your department with another similar department of a different organization. So you're comparing how the organization's department is performing, then with a competitor's department, with the aim again of improving how the department is doing. So if it's functional benchmarking, it involves comparison of the business functions with other organizations. So we are comparing the functions of the organization with those of the competitor. Then the last one that we were given was strategic benchmarking. So if it's strategic benchmarking, let's have it down. Let's have the strategic benchmarking. Sorry. So strategic benchmarking. So the benchmarking process, it can be competitive benchmarking. You're comparing with your competitor with the aim of outdoing outdoing the competitor. Internal benchmarking, just comparing the departments within the same organization with the aim of identifying how we can improve. Then the functional benchmarking, you're comparing the functions, your functions with a competitor or a similar organization to see where can you improve. Then strategic benchmarking involves comparing the long-term strategies with those of the leading organizations or related industries. So strategic, anything that is strategic is long-term. So you're comparing the long-term objectives of the organization against those of the industry, against those of the leaders in the market. So that is strategic benchmarking. So with that in mind, let's go and check which one is the most ideal answer there. So what can we say? A manufacturing company benchmarks the performance of its accounts receivable department with that of the leading credit card company. So we are comparing our accounts receivable department with another department of the leading credit card company, sorry. Yes, Bowen, your mic is on. What do you have to say? What do you think? Okay.
Functional.
Functional. Let's check that. Yes, that's correct. So that's functional benchmarking. These are functions. These are departments of two different companies. So if you're comparing at departmental level, that's functional. Comparing the organization as a whole with the competitor, what the competitor is doing can be competitive. Which of the following best describes what you call target costing? So let me quickly summarize what happens in target costing. So target costing. In target costing, if we are in target costing, what happens is the organization wants to introduce a product in a new market. And in this market, there is already a fixed selling price. So let's think of you starting a branch in Mutare and you want to sell maybe laptops. And in Mutare, there are other firms that are already selling the laptops. So it means there is already a market for laptops in Mutare. You're not going to be the first one. So we also assume in this market, you can't charge a different price. You have to stick to the price in the market because the market is competitive. So you have to charge the market price. The market is competitive. You have to charge the market price. So the selling price is fixed. It's fixed. In target costing, the selling price is fixed. And also, as an organization, your profit, the desired profit, is fixed. So the only thing we can play around with are the costs. Because remember, the relationship that we have is that we say the selling price, or we can say the sales or selling price minus the cost. So if you buy something, if you deduct the cost, then that can give you a profit. So in target costing, we are saying the price cannot be changed and the profit cannot be changed. So what we are able to play around is the cost. So if we want to achieve a certain level of profit, we have to be lowering down the cost because the price cannot be changed and the profit as well cannot be changed. So the only variable item we can play around is the cost. Like we can be given a question like this one. We want to go and sell our laptops in Bulawayo, and the price for the laptops in Bulawayo is the price is $400, and the company targets a profit or a markup, a margin. The company targets a margin of 20% on all laptops. So we want to go and sell the laptops in Bulawayo they are going for 400. And as an organization, whenever we sell, we want a margin of 20%. So it means that for us to achieve a profit that we want, we must maintain our costs as follows. So we say selling price. The selling price is 400. And the organization wants a profit of 20%. So we're saying 400 times 20%. 400 times 20%. So that would be 400 times 20%. So it means our profit that we want is $80. So if we go and sell in Bulawayo, we want a profit of $80, but the price is fixed at 400. So how much should be your cost? It means your cost should not exceed. For you to make a profit of 80 after selling at 400, your cost should not extend beyond 320. So 320 is said to be the target cost. So the 320 is said to be the target cost. Our cost should not go above 320 because the price cannot be adjusted and the profit cannot be adjusted. So the targeted cost is 320. Now, with that in mind, let's go and look at the question. Let's go and look at the question, then you help me out. So the question is saying, which of the following best describes target costing? So which conditions do we find in target costing? Oh, it's just one. We want not conditions, but which condition for target costing? Let's be fast. What happens in target costing? Let's be fast, please. What's your take on that one? What do you think? Yes, no, D. So in target costing, we set a cost by subtracting the desired profit. That's what we did. From my example, that's what I did. So what I did is I subtracted from the selling price of 400, I subtracted the $80 profit to get the targeted cost of 320. So in target costing, we subtract the profit that we want from the selling price, then we get your targeted cost. Then now let's move on. So information relates to two processes. Process F and process G was as follows. Process F and process G was as follows. Process F, normal loss 8%. G is 5%. We are given the input, we are given the output. For each of the processes, there was an abnormal loss or a normal or abnormal gain. So what happens? Remember, what is in just a quick recap on abnormal loss, the normal loss, and gain. So remember, in process costing, we have what you call the normal loss. So the normal loss, we are saying, normal loss. So for the normal loss, so if it is the normal loss, in every process, we can be able to, if it's a process maybe that involves a liquid, if you are to use maybe 20 liters as your input, some of the liquid may evaporate during the production process. If you are into wood industry, maybe if you're into not wood, sorry, but if you're into maybe carpentry, when you're making the desks, some of the material is shaved off. So in every process, the amount of material, not every, but in most of the processes, the amount of material input is not exactly the same with the output. Some of the material is lost, not because those that were producing were wasteful. No, it's just a normal loss. We can't avoid it. So the normal loss, this is an unavoidable loss in the production process. So it's normally as a percentage of the input. It cannot be avoided. It's a percentage of the input. That is the normal loss. So in this case, we are told that we are told that the process had a normal loss or an abnormal loss. So if the normal loss is then said to be 5%, if we are saying the normal loss is 5%, we mean that in every 1,000 kgs or 1,000 liters, if it's a liquid, so in every 1,000 liters, if the normal loss is per se 5%, if the normal loss is 5%, it means we're expecting that we'll get 95%. We'll lose 5% as normal loss, then the output should be, you can say the output should be 1,000 times 95%. Because 5 originally, it's 100%. If there is no loss, it's 100%. But if we lose 5%, it means our output is now 95%. So it means if the process, the input was 1,000 liters, the output is 950, we say, no, the process went well. Even though the liters are less, the process went well. Why? Because the loss was expected. It was a normal loss. But there are cases now where the output is 900. It was supposed to be 950, but the output is 900. It means the loss was greater than the one that we expected by 50. So in this case, they say it to be an abnormal loss. So an abnormal loss, this is when the loss exceeds the normal expected loss. So abnormal loss, this arises when the loss exceeds the expected normal loss. So if the loss is actually exceeding the expected normal loss, we say there's an abnormal loss. Like in the case where the loss is now 950 instead of, it's now 900. It's now giving us an output of 900. So in terms of the loss, let's put the loss here. So the normal loss is 50 because from 1,000 liters, the normal loss is 5%. It's 50. But in this case, the normal loss was 100, which is way above what we expected. So there was an abnormal loss. Then we can also have a case where we were expecting a loss of 5%, but the output came out as 980. If the output came out as 980, it means the loss was only 20 liters. So it means in this case, they say to be an abnormal gain. So abnormal gain, we were not expecting it. So there is an abnormal gain. If the loss is less than expected, if the loss is less than expected. So the abnormal gain, the loss is less than expected. Now let's go and apply that to the question. Let's go and apply that to our question. So looking at the question, we are told that there is an abnormal loss or abnormal gain. So let's look at the first one. So for the first one, our normal loss is 8%. You can read the question. Maybe let me give you a minute to try to punch in the figures and try on your own before I intervene. Just quickly try that. Okay, are you done now? Can I have the answers? The first process, is there an abnormal loss or abnormal gain? Let's be fast. Is there an abnormal loss or an abnormal gain? Okay, so for the first one, let's look at the loss first. So we were expecting, can you please quickly work this one out? We were expecting, the actual loss is, our input was 65,000, but we got 58.9 as our output. What's 65,000 minus 58.9? What's the loss in the first case? So let's have the loss for the first case. So the loss for the first case, you're saying 65,000 minus what? That's 58 what? Okay, could I say 6.1? 6.1, is it the final answer? Is 6.1 the loss?
No, it's the actual loss.
All right, that's the actual loss. So it was, how did you get 6.1? It was 65,000 minus what?
58,900.
58,900, okay. So the actual loss is 6.1. But remember, our normal loss is 8% of input. So our normal loss was supposed to be 8% of 65,000. So you were expecting to lose 5.2, but you lost 6.1. Is that normal? It's an abnormal loss. So the first case is an abnormal loss. Then let's again test the second one. The second loss, for the second loss, so the first one we've said it's abnormal because you lost more than what you expected. Then now let's look at, so the first one is abnormal loss. Let's look at the second one. The loss is 5%, but what is the actual loss? 37.5 minus 35.7. 37.5 minus 35.7. What's the actual loss? 9.8. 1.8. So I'm told the actual loss is 1.8. But what was the normal loss? It's 5% of the input. So the normal loss is 5% of the input, that is 37.5. So it means the normal loss is higher than the actual loss. So you're supposed to lose 1.875, but you only lost 1.8. So you actually gain. Your loss was less than you expected. You expected a higher loss than the one that you ended up losing. So indirectly, if the loss is less than you expected, it's a gain to you. Let's go back here. Abnormal gain, the loss is less than expected. Our loss is 1.8, is less than expected. So don't always assume that, again, the first one, since the first one was abnormal gain, maybe don't just say, okay, since the first one has abnormal gain, so the other one is abnormal. If the first one has abnormal loss, the other one is abnormal gain. You calculate to prove. You can be given both situations with abnormal loss or either way. Let's move on. The following budget information relates to a manufacturing company for the next period. We have the units, 14,000 production units, 12,000 sales units. The fixed production cost, they are 63,000. The fixed selling cost, they're 12,000. The normal level of activity is 14,000 units per period. Using absorption costing, the profit for the next period has been calculated to be 36,000. What would be the profit using marginal costing? So remember, we have marginal and absorption costing. We have marginal and absorption costing. So marginal, or if it's absorption costing, absorption costing is sometimes called full costing. So the absorption costing or full costing, this absorbs all the cost of production into the product. So if it is absorption costing, it involves all the costs of the product in closing stock. When you're calculating closing stock, it values closing stock. It values closing stock. It values closing stock at full production cost. If you're dealing with absorption costing, it values closing stock at full production cost. And what is full production cost? Production cost is equal to what? Production cost is equals to variable plus fixed cost. So if it's absorption costing, it tends to value closing stock at a higher value because it takes into account all the costs when determining the value of closing stock. It values closing stock at a higher value. It values closing stock at a higher value. On the other hand, we have marginal costing. Marginal costing or contribution costing. This only takes into account variable cost. So it values closing stock. It values the closing stock at full, not at full, sorry, at total variable cost. So when determining the value of the closing stock, we value it based on the total variable cost. If it's under marginal costing, we value the closing stock at total variable cost. So the variable cost only, if we are valuing closing stock based on variable cost only, it means a lower value of closing stock is reported because the value of closing stock excludes the fixed cost. So it reports a lower value of closing stock. So it tends to report a lower value of closing stock. Then for marginal costing, or let's not talk about marginal costing. Let's look at profit in general. Profit and closing stock have a direct relationship. Profit and closing stock, they have a direct relationship. What does this mean? If you increase closing stock, you also increase profit. If you decrease closing stock, you also reduce profit. So in other words, since absorption costing values closing stock at full production cost or at a higher value, it also reports a higher profit than marginal costing. So absorption costing reports a higher profit than marginal. Absorption or we can say if closing stock is rising, if closing stock is rising, that is comparing opening and closing stock. If there is an increase in closing stock, if closing stock is rising, absorption profit reports a higher profit. Absorption costing reports a higher profit. If closing stock is rising, absorption costing reports a higher profit. If closing stock is rising, absorption profit reports a higher profit. Then if closing stock is falling, marginal cost reports a higher profit. So if closing stock is rising, it means we are going to value it at a higher price, also resulting in a higher profit. Then we can reconcile the profit under absorption and profit under marginal. So the reconciliation of the profit under absorption and profit under marginal, we say absorption profit, absorption cost profit, absorption cost profit, so that differences in stock, difference in stock times OAR, overhead absorption rate. We multiply the difference in stock with the OAR. If you subtract that, you get your marginal costing profit. That will give you your marginal costing profit. So let's go and apply that to the question. The question, if I remember, it was giving us a profit. We were given a profit for absorption costing. And they want us to work out the profit for marginal costing. Let's go to the question. So the first thing to take note of is stock rising? If stock is rising, it means absorption costing has a higher profit. It means the profit for absorption costing is higher than that of marginal. So in this case, the business, we are not told of opening stock, so we can assume it was at zero there. But we produced 14,000 units and we sold 12,000. So if you produce 14 and you sell 12, it means you remain with stock of 2,000. So it means now your closing stock is risen from 0 to 14, sorry, 0 to 2, because you produced 14,000 units and you only sold 12. So it means you now have a closing stock of 2,000. So if the closing stock is higher than the opening, absorption costing reports a higher profit. So it means the 36,000 is higher. To get to marginal costing profit, we have to subtract. We subtract like the same way we did on that format that I gave you. If absorption costing profit was lower, that is, if closing stock was falling, if closing stock was less, it means we would add. Where am I talking about adding and subtracting? So here, if absorption costing, if the inventory is rising and we have absorption cost profit, we subtract to get to marginal, because if inventory is rising, absorption cost is a higher profit. But if inventory is falling, it means marginal costing will have a higher profit. Now, let's go and substitute. Let's go and substitute that. So absorption costing profit was given as 36,000. Then the closing inventory or the difference in stock. We're not given opening stock, so the assumption is it was at 0, and now it's at 2,000. So the difference in stock is 2,000 times our OAR. How do we work the overhead absorption rate? So the overhead absorption rate, you say the budgeted cost or budgeted overhead over budgeted base. Budgeted total overhead over budgeted total base. So in this case, our budgeted total overhead was given in the question. So how much was our budgeted total overhead? If we go to the question, how much is the budgeted total overhead? So the budgeted total overhead is the fixed production cost. So the fixed production cost is 63,000. We divide that by the normal level of activity. We use the normal level of activity as our base. So we are saying, oh, by the way, how much was I remember 14,000 normal level of activity. What was the cost? The cost is 63,000. So the production cost, you're taking the production cost, you divide that by the normal level of activity. So 63,000 is the budgeted production overhead divided by the units, the 14,000 normal level of activity. So we get our overhead absorption rate. So our overhead absorption rate becomes what? So our overhead absorption rate, can we quickly work out that? What's 63,000 divided by 40? What's our overhead absorption rate? 4.5 is our overhead absorption rate. So that's 4.5. Then we say 2,000, which is the difference in stock, times the 4.5. So that's the difference in stock times OAR. How much does it give us? 9,000. 9,000. So it means our marginal costing profit is going to be 27,000. So please take note. Why did I subtract here is because the closing stock was higher. If the closing stock was lower, so if the closing stock was lower than the opening, we would do the opposite. Now let's move on. Let's confirm that our answer is correct. 27,000. Yes, they've marked that one. Let's move. Okay, here is a question. So we are told that Eastland, the Eastland Postal Service is government owned. Remember, if it's a government owned entity, take note of that. The government requires it to provide a parcel delivery service to every home and business in Eastland at a low price, which is set by the government. And that's typical of government entities. They are not aimed at making a profit. So we are told that here, Eastland Postal Service is supposed to provide services at a low price set by the government. Express Courier is a privately owned parcel delivery company that also operates in Eastland. It is not subject to government regulations. Okay, so this one is not controlled by the government. They set their own rules. And most of its deliveries are to large businesses located in Eastland's capital city. You have been asked to assess the relative efficiency of the management of two organizations. Want to see the efficiency of the management of the two organizations. Which of the following factors should not be allowed for when comparing the ROS of the two organizations to assess the efficiency of their management? Let's remember the ROS. The ROS is the return on capital employed. Let's talk about the ROS. The ROS looks at the return on capital employed. It is the return So ROS is a ratio that is mainly focusing on from what we injected, are we benefiting from the investment? Is it yielding benefit or we made a waste of resources? So if there is a higher return on investment, it means the investment is giving us the benefits that we want. But if the return is low, it becomes a cause for concern. So if we are assessing the rate of return, it might differ based on whether it is a government-owned entity or a private-owned entity. So for a government-owned entity, they are not profit-oriented. So they don't assess their ROS based on profitability. So the return that they are looking for is not profitability, but the government is basing on 3 E's. Their main focus is value for money, which looks at, are we being economic? Are we saving costs? Are we being efficient? Which is one of the factors which was mentioned. They focus on efficiency. They focus on effectiveness. If we have put an investment in this courier company, they would say there's a return if maybe we are effective. If whatever system we are using is able to give us the results that we want, then we can say there's a return on investment. Then on the other hand, the profit-oriented companies, they look at profit because that's their main objective. If the project is going to give us a higher profit, we are doing well. Okay, now looking at the question, we want to look at which factor. In other words, the question is saying, if you are assessing whether the managers are doing well, which factor should we not say, okay, this is a government-owned entity, and this one is for, because there are factors that make it difficult to compare performance for these two firms, because one is a private entity, the other one is a government entity. So which of the following factors should not be allowed when comparing the ROS? So when you're comparing their ROS, which factor should we set aside? Number one, the differences in prices. We can't set aside the differences in prices because these firms, one is being controlled by the government, they are being told what price to charge. So we have to factor in the comparison, we have to factor in the differences in prices. Difference in objectives pursued. We have to factor in again because they might charge high prices because their objective is profit aimed. They are not profit aimed. So the difference in objective could result in the difference in the ROS. So when you're assessing the difference in the ROS, we can factor in the differences in prices, differences in objective, differences in geographical areas. Yes, we might also differences in workforce motivation. Now that one is a tricky one. So motivation should not be affected by whether is it a private or is it a public. So a manager can't say I failed to motivate my employees based on the fact that I'm not a private, I'm not a government-owned entity, or I'm not a private limited company. So every manager has the duty to ensure the workers are motivated, be it private-owned or public-owned. So you can't use motivation as a room to say, no, this is why we failed to perform, because our workers in public limited entities are less motivated than the private. As a manager, it is your duty to provide motivation, even if it's a public limited company. So it means you can't set aside, or you can't say this one failed to perform because of motivation and we understand it. No. So looking at the question, difference in workforce motivation is not a factor we should put into consideration when comparing the performance of these two firms. Under which sampling method does every member of the target population have an equal chance of being selected? Equal chance of being part of the sample. So we have, the stratified sampling. In stratified sampling, the population is divided into what we call strata. So in stratified sampling, it's not every member that will be chosen. We randomly select the strata. We can say in Zimbabwe, we can break down Zimbabwe into different provinces. Then we randomly select a province. In those provinces, maybe we break down the province into different districts. We randomly select the districts. Then, so it means in stratified sampling, not every member has equal chances of being picked. Then systematic sampling. This is where we are using a certain formula. You can say maybe you ask one person, you skip another, and you ask the next one. So in systematic sampling, again, not all members have equal chances, but random sampling gives every member equal chances of being selected. So let's move. Okay, there is a question. A company manufactures and sells one product which requires 8 kgs of raw materials in its manufacture. Over to you. Can you try this? Then I help you. Can't be the one talking alone. I'm giving you a minute to try that. Or maybe let me add on 1.5 minutes. So now it's 3 minutes. Quickly try that. Okay, quickly finish up, please. Anyone done? No, what about there is some? Uh, uh, uh. Okay, so a company manufactures and sells one product. Anyone who is done, who may want to share their answer? Oh. Okay, let's go through it together. Those who can take a pick, you can take a pick so that when I leave this screen, you'll be able to help me out with the amounts. A company manufactures and sells one product which requires 8 kgs of raw materials in its manufacture. The budgeted data relating to the next period is as follows. The budgeted data is as follows. Okay? We are given the sales, we are given the opening stock. What is the budgeted raw materials purchases? So it's about budgeting the raw materials. So for us to tell the raw materials budget, let's have the raw materials budget says, we say, let's go to our Excel. So we have the raw materials budget. Raw materials budget. So for the raw materials budget, we say usage. For the raw materials budget, we say usage That is the material that you are going to use, plus the material that you remain with. So usage plus closing stock. If you buy material, you want the one that you use plus the one that is remaining in stock less the opening stock. So if it's the raw materials budget, you say the usage plus the closing stock less the opening stock. This is in terms of material. The material you are going to use in production plus the stock that will remain minus the opening stock for the material. If you do that, you then get your this will give you the raw materials budget. This will give you the raw materials budget. So in this case, we need the material usage. So the material usage was, I can see on the question, there was opening and closing stock. The material usage is the material needed in production. The material usage is the material needed in production. So how do we know the material needed in production? We are going to say the production units times is the production units times the production units times the material per unit. The production units times the material per unit. So in this case, let's go back to the question. Were we given the production units? I can see we have the opening stock of raw materials, the closing stock of raw materials. We are not told the units produced, but we are told that each unit used 8 kgs. So if you are not given the units produced, you have to work out the units produced. How do you do that? We use the production budget. So we first of all need to know how many units were produced, so we use the production budget. So the production budget tells us how many units were produced. So for budgeted to be produced, not that we produce, it's still a budget. So it tells us how many units you're planning to produce. We say again, closing stock. Closing stock plus sales less opening stock. That's production budget. Closing stock plus what you're planning to sell. Closing stock plus sales. So your closing stock plus your sales, you less your opening stock. You less your opening stock. This will give you your budgeted production. So the steps were quite long for this one. The first thing was to work out your production. Now can I have the figures? How many units? The production budget is done in units. How many units are we planning to produce? Sorry, how many units are for closing stock? How many units are for closing stock? Watorama Pictures, can you help? The closing stock units is how many? Units, not inventory, not raw materials, sorry. So 3,000 units are the closing units. Then how many units are we planning to sell? 19,000. So that's 19,000 plus 3,000. That gives us what? 22,000. Then we less the opening inventory. So if we remove our opening inventory, how much was the opening inventory? 4,000. We then get our production budget. So this will tell us how many units we are planning to produce. So we are planning to produce a total of 18,000 units. So now we know we want to produce 18,000 units. So each unit, we are told it requires 8 kgs. So how many kgs do we need for all the units? If each unit is requiring 8 kgs and we want 18,000 units, so how many kgs do we need? 144 kgs. These are the kgs that we need, right? Then let's come to the raw materials budget. We then say the raw materials we are going to use in production. Now we are using the raw materials. It's 144,000. Then we are supposed to remain with a closing stock of how much in raw materials? What's our closing stock of raw materials? 53,000. So we are going to use 144, but we want to remain with 53. So in total, how much do we need? It means we need 197. But we already had some material in stock. How much was the opening inventory? 50,000, yes. So it means how much should we buy? So the raw material that we need to buy is then 147,000 kgs. So we need to use 144, but we must remain with 53. So in total, we must have 197. That is what we are going to use and what is going to remain in our stock. But already we had 50,000 units. So it means if we already have 50,000, we need to deduct the 50,000 so that we can calculate how much should we buy. Let's go back to the questions. Okay, here are the graphs. We are told that up to a given level of activity in each period, the purchase price per unit of raw material is constant. So it's not changing. The purchase price, remember, material cost is a variable cost. And variable cost per unit, normally they do not change. So that is what they're telling us. The material price is not changing. It's constant. After a point, a lower price per unit applies to both the further units purchased and the retrospective units. Retrospective, it means to those that we bought already. So we are saying after a certain point, the price per unit is going to drop. So the price is variable, but after a certain point, it's going to drop. The price is variable. After a certain point, it's going to drop. So the question then says, which graph shows this? Which graph shows this? Is it A, is it B, is it C? So which graph shows this? So the costs are going to be variable, and at some point, the costs are going to drop. So what does this mean? For the part that is variable, you should know that the variable cost, they start from zero. The variable cost line, it starts from zero. So it can't be B. It can either be A, B, C, and D. So we've already eliminated B because variable cost, the graph that starts from here is for semi-variable cost. Variable cost They start from 0. Then the question is saying that after we reach a certain point, the variable cost per unit then falls. So when it falls with a vertical line. So it can be A. So it falls with a vertical line, meaning that already we have ruled out B. So meaning now we are left with C and D. So looking at C and D, let's look at those two now. The remaining two, the C and D. The graph that shows the condition that they are talking about. When price gets to a certain, when output, reaches a certain level, the variable cost per unit falls. If we extend that line, let's look at C. If we extend C, it should come to the origin. The graph has fallen, yes, but if we extend that extension, it should come to the origin. So if we extrapolate or extend this one, it doesn't come to the origin. If we extend or continue with this line, it doesn't come to the origin. But this one, if we continue with it, it comes to the origin. So it's most likely C is the correct answer. So we consider which graph number 1 is starting from the origin, because the variable cost graph starts from the origin. Number 2, when the variable costs are falling after we reach a certain point, they must fall with a vertical line. Then number 3, the new line, if we extend it or extrapolate it, it should go to the origin. So that is what we have used to distinguish these two. This one, it doesn't go to the origin, but the variable costs, they should come to this origin. Okay, which two of the following are benefits of budgeting? We prepare budgets. Why do we budget? What are the benefits of budgeting? Which two can be said to the benefits of budgeting? So we budget for what reason? For what purpose do we budget? So to which of the following are benefits of budgeting? It fulfills legal obligations. That's a lie. A company is not forced to prepare the budget. A company is not forced to prepare the budget. It is not a legal obligation to prepare the budget. It is not a legal obligation to prepare the budget. Number 2, beside it not being a legal obligation to prepare the budget, what else have they said which is not true? The question wants which ones are the benefits. Okay, it helps coordinate activities. Yes, budgets can help in coordination, because if we have a budget, it means we have a plan. The plan can tell us what is supposed to be done at this stage, what is supposed to be done. So the budget can be able to coordinate the activities to make sure they are working towards the same thing. So if we have a budget, we have a plan, it can help us, it can help direct the activities to make sure they are all working towards the same thing. If we don't plan, we end up doing things that are that is less of coordination. But through budgeting and planning, it enables coordination. So that one, we might take it. It is a starting point for strategic planning. That's a lie. Strategic managers don't base on budgets, but the tactical managers, yes, they can work on budgets. Strategic managers are not, of course, they use budget, but it is not a starting point. We can't say that is their initial starting point for decision making, but it is the tactical managers that design these targets, the budgets, the short-term budgets. Because remember, a budget, it is prepared maybe for a year, but the strategic managers, they go beyond even sometimes 5 years. So this one is not ideal. Let's look at the next one. It establishes a system of control. I go with this because budgets can be able to tell us when things are now going out of hand. So they can be a basis for control. A budget can tell you to know things are now getting out of hand. The costs are now more than what we anticipated. So the budget can be a basis for control purposes. We can identify that things are going out of hand by referring back to what was in the budget. So if the cost we're saying, if the budget was saying we're supposed to spend $200, and now we've now spent 220, it can tell us that things are going wrong. We need to control our spending. Which of the above statements is or are true? The following statements relates to the participation of junior managers in setting the budget. So this is where we have decentralized the budget setting process. We have decentralized the budget setting process. So the question then says, which one is true about decentralizing the budget setting process? It speeds up the setting of budgets. Decentralizing, does it speed up? If you are now encouraging or you're including everyone in the setting up of the budget, does it actually speed up the process? I don't think so, because if we include everyone, it tends to delay the process. We need to sit down, we need to be arguing, why are we saying we should put this? So if the budgetary process involves a lot of people, it can actually be time consuming because we can take time to reach an agreement. It increases motivation. Yes, it does increase their motivation because they will feel like they're appreciated. They will feel like they're part of the budget setting process. It reduces the level of budget padding. Not really. So if we are looking at the issue of budget padding, this is where we are now including unnecessary items in the budget. It can actually give room to budget padding where we are putting the budgets that are easy to achieve. If the budgets are done by juniors, they might set budgets that are too easy to achieve. They set a target that they know I can easily achieve this and get maybe the rewards that come with it. So we end up incorporating unnecessary things into the budget. So that one, it doesn't reduce. So I would go with two only. A company has a capital employed of 200,000. It has a cost of capital of 12% per year. Its residue income is 36,000. What is the return on investment? So let's go to our formulas. Return on investment. A return on investment. It's just the same with the return on capital employed. So the return on investment, that's going to be our operating profit. So that's our operating profit over our net assets times 100. So to get our return on investment, that's our operating profit over net assets times 100. But going to the question, do we have the operating profit? No, residue income is not operating profit. We don't have the operating profit. We have the residue income. Okay. Yes, the capital employed is there. The net assets is the capital employed there. We can use capital employed. So capital employed is there. So what do we have? We have the capital employed and so we have the capital employed and the residue income. But the formula is saying we should use the operating profit and the net assets or capital employed. So what then should we do in this case? So the first step, we are supposed to work out, or we are given residue income. Residue income is actually calculated using the formula. We say residue income. Residue income is equals to controllable profit minus the controllable profit minus imputed rate of interest times capital employed. So knowing the formula of residue income, how does it work? How does it help us? The profit for the residue income there is the same profit that we need on return on investment. Here's what. So we are going to use the formula for residue income to work out the profit that we are going to use to calculate return on investment. So let's substitute. The residue income was given as 30, is it 36,000, or I'm now thinking of the absorption profit. Is it 36,000 as well? Yes, it's 36,000. And the capital employed is 200,000, and the cost of capital is our cost of capital is given as 12%. So 36,000 is our residue income. So we say 36,000, which is our residue income, is equals to, what's happening here? Okay, 36,000 is equals to our controllable profit. We don't know what the profit is. That's what we are looking for. Minus the imputed rate of interest. We can use the cost of capital, which is 12%, times the capital employed, 200,000. So if you do your maths right, it means we can leave profit this side and we take everything that other side. It becomes a plus. Was 36,000 plus 12% of 200,000. In fact, was 12% of 200,000. 12% of 200,000. What do we get, please? So it is what? 24,000. So 36,000 plus 24,000 is going to give us the profit. So now we have the profit. How much is 36 plus 24? 60,000 is our profit. $60,000 is our profit. So now our return on investment. Our return on investment is 60,000 over our capital employed 200,000 times 100 to make it a percent. So what is your return on investment? Let's work together. So what is your return on investment as a percent? Yes, 30%. So that's our return on investment. Okay, let's move. So let's try that and see whether the 30 is acceptable on the answers. Yes, that's correct. A company has calculated 10,000 adverse direct material variance by subtracting its flexed budget direct material cost from its actual direct material cost for the period. Which two of the following could have caused the variance? A company has calculated 10,000 adverse. So we have adverse material variance. Which can cause adverse material variance? What can cause us to have an adverse material variance? What can cause adverse material variance? We have an A and B. Yes, Kuda, what's your take? Okay, Bowen, your mic is on. Do you want to say something?
Units produced being greater than budgeted.
Unfortunately, your line is breaking.
Units produced being greater than budgeted.
Units produced being greater than budgeted. Unfortunately, in variances, if the units produced are greater than the actual, it doesn't affect the variance because we flex the budget. So it doesn't affect the budget. So take note of that, that if the units produced are less or greater than the budget, it doesn't affect our variance. Why? Because we flex the budget. So the last two, the last one, I units sold. In this case, we are not dealing with the sales, and we're dealing with material. I think the first and the last one. So the first one, an increase in raw material usage. An increase in raw materials usage, this is material usage variance. If the usage is greater than budgeted, it becomes adverse. And we have an adverse material usage. Then material price, if they increase, we have an adverse material price. So those two are correct. Let's move on. A company has recorded the following. What was the fixed budgeted profit for the period? What was the fixed budgeted profit for the period? What was the fixed budgeted profit for the period? So let me assist first with this formula. So the fixed budgeted profit. Fixed budgeted profit is equals to, so the fixed budgeted profit is equals to standard profit. Standard profit on actual sales. Plus the sales volume variance. We can get the fixed budgeted profit by saying the standard profit on actual sales plus the sales volume variance. It can give you the fixed budgeted profit. So now I've actually helped you with the answer. So go and apply that to the question. Using what I've given you. Using what I have given. Let's be fast, please. So standard profit on actual sales is given. The standard profit on actual sales is 120,000 plus the sales volume variance. So the question is saying, the question is saying, the company has recorded the following variances for the period. So the sales volume variance is 10,000. The sales volume variance is 10,000. Then the standard profit on actual sales for the period is 120. The sales price variance what was the fixed budget? Okay, yes, if we are going to the budget, we do the reverse. So we add variances, always some favorables. So we are going back from the budget, from the actual going back to the budget. Can achieve from the actual results going back to the budget. No, edama adverse. But I achieve from the budget going to the actual, less some adverse variances. So in this case, it's from the actual going back to the budget. So you do the opposite. You add the adverse variances and you less the favorable. So if you are reconciling the budget and the actual results, if you are coming from, in this case, you're coming from the actual going back to the budget, you do the opposite. You add the adverse and you less the favorables. But if it's from the budget going to the actual, you add the favorable and you less the adverse. So I think that should give us 130 was 120. If we say 120 minus 10, you don't, okay, it's there 110. But in this case, it's from the actual going to the budget. Which of the following are suitable measures of performance at strategic level? So strategic level, we're making long-term decisions for the company. If it's a strategic decision, it's a long-term plan. A strategic decision is a long-term plan. Making plans 5 years for the company, 10 years for the company. If you're making long-term decisions, we don't just look at the financial information. Of course, we do include the financial information, but we also look at non-financial information. So for the financial information, yes, we need a project that will give us a return. That's one. But we also need to consider even the market share. So in the future, we need to consider how many people we are likely going to be selling to. So at strategic level, we are normally concerned with the size of the business and our return. So we can talk about 1 and 2 there. So we can talk about the return, what we are going to get from our investment, and also the size of the entity. Is it likely going to be large, so that our strategies can be able to fit in the size of our market? Okay, let's move on. Which two of the following are feasible measures of the correlation coefficient? So remember, in regression and correlation, when we are measuring the strength of two variables, the strength of the relationship that we have, maybe the relationship between the hours you spend studying and the mark that you get in your exam. Are these two related? So if you're measuring the correlation coefficient, the strength of the correlation, the correlation coefficient, it ranges from 0 to 1. So the measures that we can take there, sorry, it's not from 0, it's from -1 to 1. So it ranges from -1 to 1. So these ones that are greater than 1, I don't think those are correct. So it should be, because it ranges from -1. -1 don't have, sorry, there's a strong negative relationship. +1, there's a strong positive relationship. 0, there is no relationship. So the correlation coefficient, it ranges from -1 to 1. A company's operating costs are 60% variable and 40% fixed. Which of the following values would change if the company switched from standard marginal costing to absorption costing? Which variance is affected by whether we are using standard costing or we are using marginal costing? We are using, sorry, absorption costing, or we are using marginal costing. So marginal and absorption. Which variance is affected by marginal and absorption costing? It's just one. We want one. So on your answers, if it's a circle, it's just one answer. If it's a box, it can be more than one. Okay, so for material efficiency, it's not affected by whether it's absorption or marginal. The same goes with, let me just say, the material variances, they are not affected by whether it's marginal or absorption. So are the labor variances. The sales variance, we have the sales volume variance. So what is the formula for sales volume variance? Let me hear it from. Sales volume variance. How do you get the sales volume variance? How do you get the sales volume variance? So the sales volume variance is in two. There is the sales volume variance. That's where we say the sales volume, you say the standard volume minus. So the sales volume variance, we say the standard volume minus the actual volume times. So this now depends whether it's sales volume what. If it's sales volume contribution variance, you multiply by contribution. We have two types. We have sales volume contribution variance. So Dana, you can turn off your mic, just click that mic button. So we have sales volume contribution variance. So if it's the sales volume contribution variance, you multiply with contribution. This one is what uses marginal costing. Then the other sales volume variance is the sales volume profit variance. We say, oh, by the way, sorry. For the sales, we start with the actuals. You say actual volume minus standard. It's actual volume minus the standard volume. So for the sales, you start with the actuals. So times profit. So the one that uses profit is under absorption costing. So the other one uses profit and the other one uses contribution. The other one uses profit and the other one uses contribution. So going back to the question, if the variance which is affected by marginal costing and absorption costing is the sales volume variance, because the sales volume variance can be sales volume profit, which uses marginal costing, or it can be sales volume profit, which uses absorption, or sales volume contribution, which uses marginal costing. Okay, for today, let's do the last one. Let's try this one. ABC company has a manufacturing capacity of 10,000 units. The flexed production cost budget for the company is as follows. What is the budgeted production cost if the company operates at 85% capacity? So we are given production at 60% capacity and 100% capacity. Let me remind you. The production costs are split into two. The production costs are either variable or they're fixed. So the production cost, we have variable production cost and the fixed production cost. So if they give you production costs are semi-variable costs. They consist of both. Production costs are semi-variable. They have both the fixed and variable element. Production costs are semi-variable. They have both fixed and variable elements. So if you're given production cost and you are flexing the budget, split the production costs into variable and fixed. Split production costs into variable and fixed. Using the high-low method. The high-low method helps us to work out the variable cost per unit. So the high-low method says variable cost per unit the variable cost per unit is equals to difference in costs over difference in units. So we were given production costs. We were given the production cost. for these two levels of output. The production cost was 11,280 and 15,120. So 11,280 and 15,120. So we have 15,120 minus 11,280 over, so it's the difference in cost over difference in units. So in terms of the difference in units, how do you work out the difference in units? So at 60% capacity, since 10,000 units is the production maximum. So 60%, it means that would be 6,000. And was it 6 and 80%? 80%, it would be 8,000, because if you say 80% of 10,000 units, that's 8,000. Then 60% would be also 6,000. So if you do this, this will give you the variable cost per unit of production. So quickly simplify that for me, please. What is the variable cost per unit? Sorry? 1.92. Is it just straight 1.92, or there were decimals that you rounded? Oh, by the way, let me confirm the 8,000 I was doubting. Oh, it's 100%, sorry. It's not 80%, it's 100% capacity. So it's supposed to be 10,000 here, not 8,000. Quickly adjust there, it's supposed to be 10, not 8,000. 0.96. Any decimals after? Just straight 0.96. So that's the variable cost per unit. So to get the total cost is equals to the fixed cost plus the variable cost. The total cost comprises of the fixed cost plus the variable cost. So we are going to split. Let's look at, pay attention first. Just pay attention here. So if we take, for example, the cost of 15,120 is the total cost. We don't know how much is the fixed cost. Let's leave the fixed cost blank here. Plus the variable cost. The variable cost, we are told that we have calculated the variable cost to be 0.96 times at the activity level of 10,000. So the costs were 15,120 at 10,000 units. So you can then use that to work out how much are your fixed costs. So 15,120 is equals to the fixed costs plus what, 0.96 times, that's 9,600. So if you make fixed cost the subject, what becomes your fixed cost? $15,120 minus 9.6. That will give us the fixed cost figure. So the fixed cost is equal to 5520. Those are our fixed costs. So the fixed costs in total, they do not change. Let's prove that. Let's do the same for the other level. That is, if we are looking at 6,000 units. So the cost will be 11,280. The total cost is equals to fixed cost plus the variable cost per unit does not change. So the fixed costs in total do not change and the variable cost per unit. So for the fixed cost, what does not change is the fixed cost in total. Then the variable cost per unit, it doesn't change. So in this case, we are using 6,000. So it's assumed this is revision. It's just not supposed to be that difficult. You should be able to recall. So that's fixed cost plus. So at 0.96 times 6,000. Let's be fast. Time is now running out. $5,520. Or my fixed cost. So 5,520. This one is 5760. So what did I want to bring out? I wanted to bring out that the fixed costs in total do not change. So the question was saying, what is the cost at 85% capacity? The cost at 85% capacity, of which if full capacity is 10,000, then 85% capacity, it means that would be 8,500. Just say 85% of full capacity, which is 8,500. Visual. So to get your total cost, now you can say total cost, remember the total cost function, is equals to fixed cost, of which now we know the fixed cost is 5520, they do not change, plus the variable cost per unit does not change, that's 0.96, times the units is now 8.5. So what's the total cost? You quickly work that out. Say 10,680. So let's go and test that on our answers. Say 10,680. That's correct. Okay, so I think for today, let's end here. We'll resume from there tomorrow. So our next session is tomorrow, is scheduled on the timetable. So the class that was affected is the Wednesday class. We have it next Wednesday. So thank you so much for your time.